Okay guys, welcome back. So if you've been following the channel, you know that we're a pretty big fan of Jepi. It's not just me, I see you guys in the comments. A lot of people love this investment. If we take a look at the assets under management for Jepi, we can see how they've been exploding even well into 2022, reaching about $9 billion. But JP Morgan just issued a new version or variant of this ETF called the Nasdaq Equity Premium Income ETF, or ticker JEPQ. Now, considering the massive success of the original, it's kind of no shock that they went ahead and made a new version based around the Nasdaq. We can see the expense ratio is the exact same, 0.35, and the overall goal here is identical. So it's designed to provide current income while maintaining the prospects for capital appreciation. And when I say this fund is brand new, I mean it's 5 days old. Its inception date is May 3rd of 2022. So in this video, we're going to take a deeper dive into this new variant of Jepi, see if it's any good, and I'm going to give you guys my outlook on this version of the ETF. And of course, if you guys enjoy the content, I always appreciate a like, subscribing to the channel. But let's get into this. So if you know anything about Jepi, this should all sound extremely familiar. So it generates income through a combination of selling options and investing in US large cap growth stocks, seeking to deliver monthly income streams from associated option premiums and stock dividends. And overall, it seeks to deliver a significant portion of the returns associated with the Nasdaq 100 index with less volatility. So quick refresher on how this ETF operates. It's what I call a hybrid ETF because the vast majority of the assets are in equities, in this case that of the Nasdaq 100, but a pretty significant portion, around 20%, is invested in these ELNs, which are very similar to call options and is used to generate consistent income, smoothing out returns. Just like regular call options, they do cap your upside potential, but this is only a small portion of the portfolio, and when you combine that with the income they generate, you should end up having roughly the same returns as the overall index over long periods of time. So to quickly read a bit more directly from the source, in implementing the fund strategy, the fund invests significantly in the equity securities of the companies included in the benchmark, which includes large and mid-cap companies. Somewhat importantly is that the fund may also invest in other equity securities not included in the benchmark. The fund may receive income to the extent it invests in equity securities of companies that pay dividends. However, securities are not selected based on anticipated dividend payments. So when it comes to Jepi, I believe 1 to 1.5% of the dividend pays is actual dividends from companies. But that's not the major source of income, and it's not even a major factor when selecting equities to invest in. And when it comes to this version of the ETF, which is based around growth companies, actual dividends is going to be a very small portion of the payout. In order to generate income, the fund may invest up to 20% of net assets in ELNs. Now, in this video, I'm not going to go in depth and explain what ELNs are. I've done that before on the channel, so check out those videos if you want to know. The description they give right here of ELNs, in my opinion, isn't super helpful. I mean, right here it says ELNs in which the fund invests are derivative instruments that are specifically designed to combine the economic characteristics of the benchmark and written call options in a single note form. So again, check out my video if you want to have an actual useful explanation, but essentially they do act as call options. They limit your upside potential and they generate pretty consistent high levels of income. Okay, so after reading that, we can conclude that the actual mechanics and the strategy of this new version of the ETF is exactly the same as Jepi. It's just that it's based off of a different index than Nasdaq 100. Now, as mentioned, this new ETF is only 5 days old, so we can't evaluate its past performance. So I think the best thing we can do in this situation is to evaluate the performance of Jepi against its benchmark and try to draw some conclusions about the new fund. Okay, so on the left we have Jepi, and on the right we have the S&P 500, which of course is the benchmark. Over the past 1 year, this is the price performance between the two. Jepi is down 3.7%, and the S&P 500 is down only 1.58%. Now, at first glance, this might be a little bit surprising because Jepi is supposed to be less volatile. But if you look a bit closer, you can clearly see what's going on here. Most of the volatility we're experiencing right now started in the beginning of this year. So if we evaluate just this time period between the two funds, we can see that Jepi is indeed holding up to its promise and delivering more security. So coming back to the 1 year view, the reason why Jepi is down slightly more than the benchmark is because of the first half of the year. This was a time where equity prices were going up basically every single day. And during times like this, covered call and option-based ETFs do tend to slightly underperform. Jepi definitely did have great price appreciation during this time, but it was somewhat limited, and that's why overall Jepi's down a little bit more, even though more recently during the volatility it's been holding up better. Now of course this is just the price behavior of Jepi versus its benchmark. The main metric you want to look at in terms of its real performance is the total return, because this includes that massive dividend, which is kind of the main point of this investment. So Jepi currently has a dividend yield of over 9%, and just like with the new version of the ETF, this is paid out on a monthly basis. So if you take that dividend and reinvest it, this is the actual returns of Jepi since the inception date, and it has an annual return of 17.38%. And we can see how the dividend really helps to smoothen out the return over time, helping to lessen the volatility, especially during the most recent bout of volatility. If I go between the two, we can see just how much the dividend has been helping during this time. Now again, comparing this against the performance of the benchmark, it still has slightly underperformed during this short period of time, and that's kind of the price you pay for the high dividend and the less volatility. And then finally, another metric I want to focus on is the actual income and dividend payments. So a pattern I want to point out here is that during the high volatility in the market, the dividend payments of Jepi have been increased versus less volatile times. So we can see so far in 2022, the average monthly dividend payment is about 46 cents per share. And in 2021, when the market was doing nothing but going up, the dividend was a lot less at around 34 cents per share. And this just confirms that the ELNs do indeed operate a lot like call options, because here is the dividend history of XYLD, which is pure systematic covered calls on the S&P 500, and this has the same exact behavior. So to summarize, this is what we know about Jepi that we can hopefully apply to the new version of the ETF. So the price action is pretty similar to the benchmark, although during times of a rising bull market, it does tend to fall behind, but hold on to its value slightly better during volatile times. And if we reinvest the dividends and take a look at the total return, the performance increases pretty dramatically. And finally, in terms of the dividend, we can see that during times of high volatility, the monthly dividend actually increases pretty noticeably, and that goes a long way to help smoothen out the returns during especially volatile periods. So I think a lot of these characteristics will translate over to Jepq. It should generate a slightly higher dividend yield, have more volatility than Jepi, but less than the actual index. I also can't help but make the comparison between these two new funds and XYLD and QYLD. Now, of course, these two companies make very different ETFs, but at the core, they're both option overlay strategies on both the S&P 500 and the Nasdaq. And when it comes to these two funds, my favorite as well as the best performing has been XYLD, which is based off of the S&P 500. Of course, they function exactly the same, but the main reason for this is because at some point, an index becomes too volatile for an option overlay strategy to work effectively. So when it comes to QYLD, the index simply has major dips far too often for the strategy to work. Because remember, call options limit upside participation. But again, I do want to give the disclaimer that Jepi as well as Jepq are very different. They're hybrids, and 80% of their portfolio is pure equity investments. Now, I'm not saying that Jepq is going to have the same fate and underperform. I'm just saying that so far, Jepi has had great performance. It has annual returns since inception of 17%, and the dividend yield is already very high at 9.72%. So I would say Jepq does have the opportunity to outperform Jepi, depending of course on what the market does, although the returns so far from Jepi have been stellar in my opinion. But let us know in the comments down below what you think on the whole topic. If you're still watching and enjoyed, I appreciate a like on the video, go ahead and subscribe, and I'll see you guys in the next one.